Hello, my name is Farha binti Jaini and I will be presenting on the financial ratio. The company we have chosen to analyze is Mr. DIY Group Berhad. We have conducted a financial ratio analysis for the past 3 years covering 2022, 2023 and 2024. There are many types of financial ratio used to assess a company's performance, but in this analysis, we focus on 4 main categories. First is liquidity ratio, profitability ratio, efficiency ratio, and leverage ratio. I will start with liquidity ratio. There are 2 main ratios used to measure liquidity. The first one is current ratio and quick ratio. To calculate the financial ratio, we obtain data from the company's annual reports, specifically from the statement of financial position, balance sheet, and statement of cash flows. The current ratio is calculated by dividing current asset by current liabilities. As we can see, current ratio are increasing from year 2022 to 2024. Meanwhile, for quick ratio, the formula is current asset minus inventory divided by current liabilities. As we can see also, the quick ratio is increasing from 2022 to 2024. Next is efficiency ratio. The 2 main ratio to measure efficiency is inventory turnover ratio and average collection period. To calculate inventory turnover ratio, we need to divide net sales by inventory, and as we can see, the inventory turnover ratio for 2022 is 3.62, 2023 is 4.02, and 2024 is 4.30. To calculate average collection period is by dividing receivables by average sales per day, and as shown is the average collection period for the past 3 years. Next is profitability ratio. There are also 2 main ratios used to measure profitability. The first one is gross profit sales ratio. The formula for gross profit sales ratio is gross profit divided by net sales. And as we can see, the gross profit sales ratio for 2022 is 0.41, 2023 is 0.45, and 2024 is 0.46. For net profit sales ratio, the formula is net profits divided by net sales, and the result is 0.12 for 2022, 0.13 for 2023, and 0.12 for 2024. Lastly, we have leverage ratio. There are 3 main ratios used to measure leverage. The first one is debt equity ratio. The formula is simple, which is debt divided by equity. As we can see, the debt equity ratio for 2022 is 1.32, for 2023 is 1.03, and for 2024 is 0.96. Second is interest coverage ratio. The formula is earnings before interest and taxes divided by interest payable on loans. For 2022, we get 84.29. For 2023, we get 75.58. And for 2024, we get 75.24. Lastly is fixed charges coverage ratio. After calculating using the formula, we can see that the fixed charges coverage ratio for 2022 is 53.71. For 2023 is 53.08, and for 2024 is 75.56.
I am Rosami Zayanti. Today I will be presenting a summary of the financial ratio analysis for Mr. DIY Group Berhad. First is profitability. Over the past 3 years, Mr. DIY has shown a consistent increase in both gross and net profit margins. The gross profit margin from RM 0.41 in 2022 to RM 0.46 in 2024. This showing a strong cost control. The net profit margin remains stable around RM 0.12 to RM 0.13. This meaning that the company earned 12 to 13 cents in profit for every ringgit of sales. Overall, this indicates that Mr. DIY is financially healthy and continues to generate solid returns. Next is liquidity. The company current ratio improved from 1.91 in 2022 to 2.38 in 2024. This means This means that Mr. DIY has over Rm2 ringgit in current asset for every Rm1 ringgit of liabilities. This shows a strong position of liquidity. While the quick ratio, which includes inventory, also improved from 0.38 to 0.68, this showed the better management of cash and receivable. This strong liquidity indicates that the company can easily meet its short-term financial obligations. Now, let's look at the gearing position. The debt-to-equity ratio decreased from 1.32% to 0.96%. This meaning that the company relies less on the borrowed funds and more on its own capital. The interest coverage ratio remained very high, over 75 times, which means the company easily covers its interest payment. The fixed charge coverage ratio also improved, showing that long-term obligations are well managed. In summary, the company has low financial risk and a solid capital structure. Lastly is the operational efficiency. Operational efficiency is also very strong in this company. The inventory turnover ratio increased from 3.62 to 4.30, which means inventory is moving faster and sales are steady. This reflects good inventory management and strong customer demand. It also suggests that the company is making the most of its resources. Thank you.
Hello, my name is Nurfara Zaya binti Awang Taib, and I will be presenting the financial strengths and weaknesses of Mr. DIY Group Berhad based on its performance from 2022 to 2024. First, the company has strong liquidity. The current ratio improved from 1.91 in 2022 to 2.38 in 2024, showing that it can comfortably meet short-term obligation. Profitability is another strength. Gross profit margin increased from 41% to 46%, and net profit margin remained steady at 12% to 13%, indicating good cost control and steady earning. Next, we look at capital structure. The company has shown improvement in its gearing. The debt-to-equity ratio decreased from 1.32 to 0.96, indicating lower financial risk and stronger reliance on equity funding. Moreover, debt servicing is very strong. The interest coverage ratio remains above 75 times, which is excellent, and fixed charge coverage ratio also increased to 75.56 in 2024. This shown that the company can comfortably meet its financial obligation. Despite this strength, there are a few weaknesses. One is the quick ratio, which although improving, stay below 1.0. This could indicate some reliance on inventory to cover short-term debt and a potential liquidity issue if inventory is not quickly sold. Also, the average collection period increased from 8.93 days in 2023 to 11.65 in 2024. While still short, the trend should be monitored as slower collection could affect cash flow. In conclusion, Mr. DIY is in a strong financial position with solid liquidity, stable profitability, and minimal debt risk. The company is financially sound and capable of managing additional funding, such as the 10 million ringgit working capital loan. Minor concerns like the quick ratio and collection timing should be addressed, but overall the financial support a positive lending decision. Thank you.
Hi, my name is Farah Nur Natasha. I would like to present part recommendation and suggestion to the bank. Given the finding, is relevant for the bank to offer the loan facility to the Mr. DIY company, even if the assessment is only based on a financial statement. This is because the financial statement demonstrate how well the company managed their business operation and finance. Financial statement analysis that conduct above on Mr. DIY company show that company has a strong financial statement by its profitability, liquidity, gearing position, and operational efficiency. To minimize the risk and give more benefit to the bank advised to look into Mr. DIY credit history. This to increase the creditworthiness of Mr. DIY whether has good record of repaying debts. There are few reports that can use to do credit analysis. First is Central Credit Reference Information System. CRIS is the list of financing and repayment of borrower over the past 1 year. The bank can assess the potential borrower, which is Mr. DIY, before offer the loan facility by the credit information that provide in the report as well as requested. Second is CITOS report. CITOS is the company which is a credit reporting agency that issue the credit report of the company. Different with CRIS, CITOS report can help the bank to know whether the company have bankruptcy through the past financial behavior. So I can conclude that bank can offer the 10 million loans to the Mr. DIY confidently even only look to their financial statement only. This has been strongly supported by strong profitability, great liquidity position, and low gearing and high debt repayment capacity, and efficiency inventory turnover ratio. That's all from me. Thank you.
Next is other important factors beyond the financial statements that we as a credit officer must consider before approving the RM 10 million loan. So first we evaluate collateral and security for Mr. DIY. This could include properties, inventory, or receivables. This asset helps reduce the bank risk if repayment issues arise. And second, we assess market conditions and industry risk. Factors like retail demand, inflation, and supply chain stability affect the company's ability to generate consistent income. So the third, we consider repayment capacity. This involves reviewing the company cash flow strength and debt servicing ability to ensure they can comfortably meet loan obligations. And lastly, we look at the borrower's character and credit worthiness. A strong credit history, ethical conduct, and good reputation strengthen trust and support a positive lending decision. So these elements help us with a well-rounded credit assessment before loan approval.